On the NYSE, we have about 2,000 companies. We also operate the NYSE Amex exchange, which has about 340 companies. And we operate the European markets on Euronext, which has roughly 1,500 companies. And so we have a global issuer base that actually, when you look at the combined value of those issuers, it's nearly $13 trillion in market capitalization. One of the decisions that any company has is determining when they would want to be a public company. And the advantages to being a public company means permanent access to capital, access to the deepest pool of institutional and retail investors, the ability to provide liquidity for your employees and stakeholders, as well as providing capital for acquisitions. And so it becomes a very strategic decision for a company to access the public markets. When a company does a public offering, it has to comply with an entirely new set of regulations, as well as internal controls that it didn't have to as a private company. That comes at a significant cost to most private companies as they consider whether or not to go public. When you're talking about costs that reach upwards of $2.5 million to go public, that's a significant bar for many companies to reach. And so a lot of companies ultimately decide it's not worth it. They would rather pursue an exit via mergers and acquisitions versus a public offering. In the 1990s, as an example, you had 400 or 500 companies a year go public, where today we have between 100 and 200 companies going public. The average time to going public now takes around 10 years, where it used to take anywhere between 2 and 4 years. And if you looked at exits 10 years ago, it was 20% of the companies that would exit via M&A. And today, nearly 80% of companies that are formed have their exit through a merger or acquisition rather than an initial public offering. Mergers and acquisitions tend to result in job loss versus job creation for those companies. So if we want to maintain the job creation, the innovation that comes out of the U.S. economy, we have to be able to provide an environment that provides access to our public markets. The public markets provide the greatest opportunity for job growth, and yet we see opportunities to lower the burdens for companies, lower the cost for companies in going public. Over the last few years, we've been working with regulators as well as politicians in looking at opportunities to reduce the obstacles of going public. One of the new ideas that's been developed is actually creating an on-ramp for public companies. The on-ramp idea is importantly not a reduction in regulation, but actually an on-ramp of regulation. It provides a company the opportunity to phase in certain regulatory requirements of being a public company. Anything that can reduce the burden and the costs associated with going public without lessening the regulatory protections is important. 92% of job growth actually comes after the initial public offering. LinkedIn, which went public, has already doubled its workforce. That's a significant advantage to the U.S. economy if we can provide an opportunity for these companies to go public. But the challenge is many of these companies don't want to come public because of the costs associated with complying with the regulations. And so we're very supportive of measures that would reduce the costs and the burdens of going public, largely because of the benefits that they ultimately provide to our economy.